So how does NetSuite consolidate financial data? Let's jump in and take a look. So to produce the consolidated financial data, NetSuite converts each individual entity's trial balance from its functional currency to the functional currency of its parent entity. And it does that by taking the individual trial balance and multiplying each account by its respective consolidated exchange rate. We can see an example below here. So for our German subsidiary, whose functional currency is euros, we have a number of account balances outstanding at the end of the month. We have 3 different accounts. Each account is measured at a different consolidated exchange rate. Deferred expense measured at the current rate, bank charges measured at the average rate, and inventory adjustments measured at the historical rate. In this column, we have the outstanding balance at the end of the period for the entity. So 50,000 euros in deferred expense, 100,000 euros in bank charges, and 10,000 euros in inventory adjustments. In this example, we are rolling up to the immediate parent entity, being the EMEA parent entity, whose functional currency is GBP. What NetSuite will do is take the euro balances that we have in our German entity and multiply them by the applicable consolidated exchange rate for that accounting period. In this case, you will see that we have 3 different consolidated exchange rates to arrive at the GBP equivalent balances for the period. Now let's take this one step further. Now that we have those balances in GBP, how do we then roll that up to USD for our ultimate parent entity? So taking those same transactions and balances, we have those balances carried forward here in GBP. Now, as we want to roll those balances up to the ultimate parent, we are now going to multiply those GBP balances by the consolidated exchange rate. In this case, again, we have different exchange rates based upon the different account type, current, average, and historical, to arrive at USD equivalent balances that will appear in our consolidated financial statements. Now, it's worth noting that while the current rate is applied to the cumulative balance for a given accounting period, both average and historical rates are applied for each period on a period-by-period basis. So, for example, if we're looking at the period January 2023 and we are applying either the average or historical consolidated exchange rates, those rates will only apply to transactions with an accounting period of January 2023, compared to the current rate where NetSuite will look at the entire history of that account and revalue that balance using the current rate.